Good morning, grade 11s. I am going to be going through the adjustments and hopefully this will help you in answering your task. Right, so I've got the trial balance and the adjustments. So the first adjustment says, on the 31st of December 20.5, an old motor vehicle was traded in with Pine Motors. So what does the word traded in mean? It means that you basically let go of your asset. You sold your asset in exchange for something else. Okay. The purchase of the new vehicle is 126,000. Pine Motors, please refer to your textbook if you aren't able to see. Pine Motors have offered a trade-in value of 22,000 on the old vehicle. So basically that's the selling price of that traded in vehicle, what you sold it for. The cost and depreciation details of the old vehicle can be obtained from the following page in the fixed asset register. So you can see that this cost price was 60,000 Rand. When did we purchase it? On the 1st of March 20.3, and the depreciation is 20% on cost, and you would see that the date of sale was the 31st of December 20.5. So we have to work out that new depreciation for the new year, and that needs to be recorded in our financial statements because we had that vehicle for that many months before we sold it. No entries have been put through to record the current depreciation, the disposal of the old vehicle, or the purchase of the new vehicle. The amount owed to Pine Motors will be settled during March 20.6. Now remember, when it's out of our financial year, we are not interested in it as yet. I want to go on to number 2 because it's the same one and the same thing. Provide for depreciation on all vehicles, 20% on cost. Depreciation on equipment is 9,200. That was given to us. We do not have to work it out. The only depreciation we need to work out is for our vehicles. Mchunu increased his capital by providing a computer, the printer. Let me just see here. Increased his capital by providing a computer and printer worth 18,000 on the last day of the financial year. So he's increasing his capital in the form of assets. Where will you take this into account? You'll take it into account in note 7, the capital account. Okay, it will be added as contributions. So let's discuss that now. I have a traded in vehicle, which is basically my sold vehicle. I also bought the new vehicle, remember? And besides the sold and the new vehicle, I still have old vehicles in my company, which I have to take into account. So the traded in vehicle was traded in on the 31st of December 20.5. How long did I have this vehicle for before I sold it? I had it for 10 months. My financial year begins the 1st of March. So I had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 months. I sold it in December. So you had that vehicle for 10 months. The cost price of the trading vehicle was 60,000, and we've seen that in our register over there. I'm going to multiply it by the number of months that I had the vehicle for, and by the percentage rate, 20%. If you tally that up, you should get a total of 10,000. So the depreciation for 20.5 that I have to include in my financial statements for the traded in vehicle is the 10,000. I also bought a new vehicle. How long did I have this new vehicle for before my financial year ends? And you know that my financial year ends the 28th of Feb 20.6. So I bought it on the 31st of December 20.5. So I had it for January and February, and that's where my financial year ends. So I had it for 2 months. I took the cost price and I multiplied it by 2 over 12 times 20%. Where did I get that cost price? They told me the purchase price of the new vehicle is 126. So I took that 126 and I worked it out. The depreciation on the new vehicle is 4,200. Now I need to go and account for my old vehicles. If you have a look at our trial balance, vehicles amount at cost was 181,000. I also remember you traded in a vehicle worth 60,000, so you have to take that 60,000 rand out to get the value of what your old vehicles is now, which is 121,000. And because you had these vehicles for the full year, you do not have to worry about months. So 121 times 20%, we get a value of 24,200 rand. Okay, so there's the depreciation of the sold, the bought, and the old. And then your equipment was given to you. What will you do to it? You'll add all of them together in your income statement next to depreciation under operating expenses. All right, and you will show it separately in note 3, which is your fixed asset note. This is the new depreciation for vehicles, and then that would be for equipment. All right, the second part of adjustment 2, one of the owners increased their capital by contributing a computer and a printer worth 18,000. Where are you taking into account? Note 7. All right, and they told us that it has already been recorded. Yes, this has been recorded. So the 18,000 rand has been recorded in there. All right, this should be the balance at your year end. What about my balance at the beginning? Okay, contribution. So at the end it was 200,000. Okay, then the 18,000 that was contributed during the year. So 200 minus 18,000 should give you what? It should give you 182,000. All right, so that is what they mean by that. It has already been recorded. I don't want to know the value of the end of the year. I need to know the value of the beginning of the year before we contributed the 18,000. Okay. So now the next one, adjustment number 3. A debtor returned motor oil with a selling price of 1,050. The cost code of these goods is GUE/RR. The secret cost code is white sugar, where W equals 1. So it will be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. All right. So let us get the cost code of this quickly. White sugar, where W equals 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This cost code was GUERR. So G is 8, U 7, E was 5, and then 00. So the cost price of that was 875 rand. This debtor was also granted credit of 850 in respect of unsatisfactory repairs done to his vehicle. No entry has been made as yet. So what do we do with this one? You subtract the selling price from sales, because we never made the sale. We're giving him back his money. And you're going to reverse. You're going to subtract the cost price, the 875 that we just worked out now, from cost of sales, and you're going to add that 875 back to your inventory in note 4. All right, the debtor is bringing back the goods to the business, so it's increasing inventory and you have to add the 875. You will also subtract the 1050 from your trade debtors, because now he's literally giving you back the trading inventory. He's no longer a debtor to you, so you're going to be subtracting that money from him. And then you also subtract the 850, because we granted credit, from trade debtors in note 5. If you have a look at this transaction, the debtor was also granted credit of 850 in respect of unsatisfactory. So where are we going to be putting it? We are going to subtract 850 from trade debtors in note 5. Okay, number 4. An inspection of the statements from the financial institutions revealed the following. Interest on your loan has not yet been recorded for February, so 1 month is missing. The interest rate is 13.5% per annum, and the interest is added to the loan. So you're not only going to add it to note 2, which is your interest expense, you'd also taking it to your balance sheet under non-current liabilities. You're adding that interest to your loan. The business repays 2,680 per month of capital amount owed. Okay. Then the next one, interest on the fixed deposit is reinvested each month. So every time the interest is being paid out, they reinvest it into the fixed deposit. So again, you're going to take it into account when you get to note 1, interest income, and you're going to add it to your fixed deposit in your balance sheet. The bank statement for February revealed bank charges of 430, so you're going to add the 430 to bank charges in your income statement, and you're going to take the interest on overdraft into account when you are completing note 2. Alright, so I'm looking at my loan. My loan is 422,060 Rand, and I'm going to multiply it by the 13.5% to get the full year's interest, which was 56,978, and I'm going to divide it by 12 to get the interest expense per month, which was omitted for February. So what do I have to do? I am going to add to note 2. So I'm going to take the 49,500 and I'm adding 4,748. I also said I'm going to add it to the balance sheet. Okay, so you'll add it to your balance sheet there. And then again, the 2,680, they told us that we paid every single month for the past 12 months this amount. All right, so you paid in total 32,160 on your loan. So this is how you will show it in your balance sheet. You'll subtract it from loan in the balance sheet. The full amount, the capital amount of your loan, you're adding the interest that was omitted, and you're going to subtract what was paid. You will also take this to note 9 as current portion of loan which was paid. The fixed deposit, they told us that the interest per month is 296 Rand. You're going to add it to note 1 as interest on fixed deposit, and you're also going to take it to your loan, to your fixed deposit. Let me show you how much is our fixed deposit in my trial balance. The fixed deposit is 43,906. All right, so Again, in your balance sheet, next to fixed deposit under non-current assets, you'll write fixed deposit 43,906. You adding the interest, all right, because interest is reinvested, and you subtracting the 11,540 because that matured money came out, it was paid out, and then you'll get the new value of your fixed deposit. Okay, our next adjustment, the post-dated check dated the 15th of April 20.6 was entered into in the January CPJ, 27,500 Rand, and this was in respect of a payment to urban builders who had done improvements. Okay, so it's a post-dated check, keeping that in mind. What am I going to be doing? Post-dated check, the 27,500 is subtracted from your current liabilities in your balance sheet. So you're going to subtract it from the bank overdraft in your balance sheet, and you're also going to add the 27,500 to trade creditors because it's a post-dated check. You have made provision for it in your CPJ, but it has not yet been received by your creditor, so for you it is a liability. All right, number 6, an insurance premium of 1,320. One of the policies was paid and recorded on the 1st of August 20.5. This policy expires on the 31st of July 20.6. So whenever you have this, it's important to draw a timeline. The insurance policy, a total of 1,320. I'm going to divide it by 12 in order to get what is the value I would pay per month. And per month I will be paying 110 Rand. Important, your timeline, we took this out on the 1st of August 20.5 and it expires the 31st of July 20.6. And again, your financial year ends in February, so you want to know how much of this money have you paid in advance. So if we work out our timeline from the 1st of August to the 31st of July, in advance I've paid for March, April, May, June, and the whole of July. So 5 months have been paid in advance. So I take 110 times 5, which will give me a total of 550. What will I do with this? I will take it to note 5 as a prepaid expense, 550, and I will subtract it from my income statement in insurance. So I'll get my insurance figure in my trial balance, which is 8,640, and I'm going to subtract the 540 from that because it does not fall in my financial year. The next is one of the employees was owed wages 600 for the last week in Feb. However, with the partner's permission, he had taken motor oil at a cost price of 400, so that is going to affect your trading inventory. The difference will be settled by the business in March 20.6. We're not going to worry about the difference because that will be taken into account in March. His pay as you earn deduction is 80 Rand and the UIF is 1%. And the business contributes on a Rand for Rand basis to UIF. It is the policy of the business to debit these contributions to salaries and wages. So that one is a little bit of a long one. So I wrote my notes down in detail. Okay, so you're going to add it to your income statement. Under salaries and wages, you're going to take your trial balance figure and you add in the 600 Rand, which is his monthly payment, and you also add in the 6 Rand, which is his UIF. All right. You are adding that because it is an expense for this financial year. Alright, so even though you have not paid it as yet, it still falls in your financial year and you need to account for it so that your books can be transparent and accountable. It will also affect your trading inventory. You'll subtract 400 Rand from note 4. Why? Because he has taken motor oil. So it affects your trading inventory. And it's going to also affect note 9, which is trade and other payables. The pay as you earn, you're taking this from your trial balance and you are going to add the 80 Rand. Alright, remember, even though we have not paid this expense, we still have to account for it in our books. UIF, you get that from your trial balance. He contributes 1% of his salary and the business contributes 1% of that salary. So you adding the two 6 rands. Creditors for wages. Why is this creditors for wages? You are saying that I have not paid this wage to this employee as yet. What is his full wage? 600. You subtracting the pay as you earn, you subtracting his UIF, and you subtracting the 400 Rand worth of oil that he has taken, and you'll work out your difference, which will obviously be paid in March 20.6. Okay, next one. During the burglary or at the office, damage was done to the building. The quote for the damage for the repairs is 12,000. The repairs were started in February and the payment of 12,000 has been debited incorrectly to Land and Buildings. The insurance company has agreed to pay out 7,000 Rand. Okay, so it affects your income statement. It's a loss due to burglary. The total loss was 12,000 Rand, but your insurance has said they're gonna pay out 7,000 Rand. So your difference would be your loss. 12,000 minus 7,000, you get your value and you put it in your income statement. Okay? It affects note 3, your land and buildings. So when you get to your note 3 under land and buildings, you go to cost. In the beginning of the year, 833,000 and you subtract in 12,000 because it was incorrectly debited. And then it will affect note 5. Why will it affect note 5? Because the 7,000 Rand is still coming in, they said to us. But the 7,000 has not yet been received, so it becomes income receivable. It's also going to affect, now we are at a different adjustment. All right, adjustment number 9. Barnes used the firm's photocopy machine to make copies for his son's science notes as he had been absent from school for 3 weeks. The 120 cost of the photocopies has not been paid by Barnes. So anything done for personal use will be seen as drawings. It affects note 8, which is your current account, drawings under Barnes, and subtracted from stationery in your income statement. So 2 things, it will affect note 8 and you're going to subtract that amount from the stationery because it's not seen as a business expense. Then I come to note number 10. The following items of stock were on hand. 61,200. You'll see that it coincides, but you still have to put it under your note 4 trading inventory. Trading stock of petrol 61,200. You still need to put that down. Then we have The motor oil per physical count 20,300, and then the 400 Rand paper for the copy machine. So let's just go here. In the beginning of the year I had trading stock of motor oil worth 21,500. So you can clearly see that there's a deficit over there. Okay, so there I got for the petrol. You just take it straight to note 4. The motor oil, if you have a look at the beginning of the year in the trial balance, subtract what we have now, there's a difference, a deficit of 1,200. But I know that in the beginning of the adjustments, they told me that this man brought goods back, and that was the cost price of it. So we added that back. And then I'm subtracting the 400 Rand because one of the employees has taken that for in place of his salary. So now I have 1,200, I'm adding the 875 and I'm subtracting 400. I get a deficit of 1,675. I cannot account for this. I don't know where it went to. That is why it is a deficit and it's an expense to the business. And I will show this in my income statement and as trading stock deficit. And I will do this very same calculation for note 4 at trading inventory. Okay, they told us that we have 20,300, so this is how your calculation will look. 21,500, we adding the 875, I'm subtracting the 400, and I'm subtracting my deficit of 1,675, which is why I have trading inventory on hand for motor oil worth 20,300. The paper for photocopy machine is your 400, and this will be recorded as consumable stores on hand. You will subtract it from your income statement and you will take it to note 4 under consumable stores on hand. Number 11. States the debtor listing reflects debtors with credit balances totaling 360. These accounts are to be transferred to creditors ledger. So what do? I take it straight to note number 9 and I add it to my trade creditors. Okay, I'm adding that amount worth 360 to trade creditors. Number 12, there was no bad debts written off, and they told you that you should provide 5% of the books. So if I work out the debtors control in my trial balance times 5%, I get the 1,990. All right, that's the books adjusted. So we're going to work on the mistake so that our books can balance. I'm going to subtract 77,000 Rand. So please make note of that when you are completing note 5. And then note number 13, the partnership agreement. You know how to do that, and I will be expecting all of your tasks on the 22nd of May, which is Friday. Thank you.